our sector outlooks for the Gulf are unchanged. And that means they're all on neutral. So we haven't revised any to deteriorating because of what we've seen. I mean, the actual operating conditions in Bahrain are still reasonable. It's more the pressure on the sovereign that puts the pressure onto the banks. As I said, that our operating environment and our operating environment score for Bahrain is capped at the sovereign level. And that's with a break-even oil price of sort of 120, 125. So quite a lot higher than the levels we are at now. It's more just this general uncertainty, this lower global growth, obviously the uncertainty around the oil prices that's impacting things. I mean, obviously we've revised down our global real GDP growth forecasts. We've revised down our oil forecast for this year from 70 to 65. So, reasonably in line with the levels that we're seeing at the moment.
Let's talk about what we're seeing in the UAE in particular as well. Emirates NBD out this week, beating expectations for the quarter, also crossing a trillion dirham mark in assets. I want to understand how sustainable that is, given some of the current macro headwinds. And as an extension to that, inside the Emirates NBD number, I note we saw really strong growth in loans and interest income. What does that tell us about the state of UAE credit demand and loan growth, given that housing is arguably at the top of the cycle in this country?
Yeah, absolutely. I mean, look, going back to the UAE, I mean, very strong operating environment conditions. I mean, obviously before the tariffs were set, we were forecasting probably around 9% lending financing growth for the UAE this year, and that really just talks to these strong conditions that we see on the ground, and that's very much supported by solid liquidity, still solid liquidity at the $65 per barrel mark where we're seeing it now. We've obviously seen a lot of inflows. I mean, the UAE is just in a strong position. Don't get me wrong, things like earnings are probably top of the cycle, but they were before we saw these tariffs and this increase in sort of the macro and the uncertainty. I mean, so put it this way, our view is that things will still remain strong for at least this year. I mean, we actually upgraded the operating environment score towards the end of last year, and that builds in quite a lot of stress going forward, and really it talks to our view that it's going to be quite sustainable.
At a macro level, we are expecting to see rate cuts coming through in the United States. That, of course, impacts this region because of the currency peg, particularly in the GCC. Regional central banks have to move in lockstep with the United States. So what will perhaps lower interest rates in the second half of the year mean for the banking outlook and banking profitability here?
Yeah. No, it's a good question. I mean, and if we take a step back, we were expecting more rate cuts. So we were expecting almost a bigger negative impact on profitability. Our expectation is probably one rate cut towards the end of the year. That means we've got, higher interest rates for longer. That actually is a positive for bank profitability, because obviously the biggest proportion of profitability is net interest income. Obviously it could be negative on an asset quality side, because obviously that means corporates and retail individuals are paying sort of higher for longer. It depends how long this lasts. But obviously with greater uncertainty, if there are pressures on cash flows with this higher for longer, you could have more pressure on the corporates, and therefore a slight deterioration in asset quality. But going back to your original question, profitability should benefit from this.
Okay, interesting to watch. And Redmond, for any investor who's sizing up this sector in the region, what else should they be thinking about in this environment? We've spoken a little bit about the risks, some of the trends you're seeing. What are we missing?
No, I think you mentioned a very important thing that we're watching: real estate prices. We know it's quite cyclical in the region. Prices have obviously been going up fast. We actually think a lot of the factors behind that are sustainable. We think particularly, the UAE and the region has changed a lot of the rules and regulations and the ability to flip things, which was behind a lot of the issues post global financial crisis. A lot of that is far more sustainable. But you're absolutely right. We're certainly watching that. We're not expecting a big correction, but it's certainly a what to watch. I would go back to what I said originally. It's really the big what to watch, the big sensitivity is oil prices, because if there's a big dip in oil prices, that will certainly affect the level of operating conditions for the banks and clearly will affect growth.
Indeed. And just based on your own view, is it reasonable to expect lower oil prices to come? Is that something that you're actively factoring into your own analysis of the sector right now?
So our expectation, as I mentioned earlier, we revised down our oil forecast for this year to 65. It's 65 for next year and it's 65 for the year after. So that is what our base case is built on. And at those levels, still operating conditions, for the region remain reasonable. Obviously, if it dips a lot below that, then immediately we'll start to see, a reduction in growth, and that could start to put pressure on earnings and profitability and asset quality. But our forecast, is 65 for this year and next.